In November 2025, the American private sector lost 32,000 jobs, a shock that defied all expert predictions. This was the largest monthly drop in over 2 years, sending waves of concern through both Wall Street and Main Street. Economists had expected job gains, not losses, with forecasts ranging from 10,000 to 40,000 new positions. Instead, the data forced a sudden re-evaluation of the economy's true strength. The timing made it even more significant. A recent government shutdown delayed the official jobs report, so this ADP data became the main lens on the labor market. The loss isn't just a number, it's a warning sign that businesses, especially smaller ones, are under real pressure. This single month doesn't make a trend, but it's a powerful signal that the recovery narrative may be stalling. As we approach the holidays, this surprise has set a more uncertain tone for the economy. The question now, is this a blip or the start of something bigger? For now, the job market's sudden stumble is a wake-up call for everyone. The next few months will reveal whether this is a turning point or just a temporary setback. The private sector is the heart of the American economy. Every business not run by the government, from local shops to global corporations. These companies create most jobs and drive economic growth. Job numbers are a vital sign. When businesses hire, it signals confidence. When they cut, it's a warning. ADP collects payroll data from millions of workers, offering a real-time snapshot of hiring and layoffs. This data is especially important when official government reports are delayed. Strong job growth means more opportunities and financial security for families. Weak job numbers, like November's, create anxiety and can slow consumer spending. That's why a loss of 32,000 jobs isn't just a statistic, it's a reflection of real economic stress. The private sector's health directly shapes the country's mood and future. Every job lost or gained tells a story about where the economy is headed. Economists entered November expecting slow but steady job growth, up to 40,000 new positions. Instead, the report revealed a loss of 32,000 jobs, a dramatic reversal that caught everyone off guard. This rare miss between forecasts and reality exposed deeper economic stress than models predicted. The disconnect shows how unpredictable the economy can be, driven by millions of individual decisions. Small businesses, in particular, were hit harder than expected. The surprise forced experts to rethink their assumptions and acknowledge the fragility beneath the surface. Now the conversation has shifted from cautious optimism to concern about stagnation or decline. The November report is a humbling reminder. Economic forecasting is never perfect. It's not just about numbers. It's about understanding the real challenges facing workers and businesses. As uncertainty grows, everyone is watching for signs of what comes next. The outlook for the new year is suddenly much less certain. Small businesses are feeling the squeeze. Rising costs, high interest rates, and cautious consumers are all taking a toll. Without big cash reserves, these companies are often forced to freeze hiring or cut staff when expenses rise and sales slow. Consumer hesitation means less spending, which directly impacts business revenue. Many companies are staying lean, operating with minimal staff to control costs. Supply chain issues and lingering pandemic effects still drive up prices and create uncertainty. To protect profits, businesses are trimming payrolls, leading to the job losses we saw in November. This isn't a wave of mass layoffs, but a steady drip of cuts and hiring freezes. Most companies aren't firing en masse. They're simply not replacing workers who leave. It's a sign of deep uncertainty. Businesses are bracing for rough waters by cutting back wherever they can. The result is fewer job opportunities and a net loss in employment. This slow bleed is a warning that the economic headwinds are real. The job market is feeling the pressure, one small cut at a time. The November job losses came almost entirely from small businesses. Those with fewer than 50 employees shed 120,000 jobs. These companies are often the first to feel economic pain, serving as early warning signals for the broader economy. In contrast, larger businesses actually added jobs. Medium-sized firms created 51,000 positions, and the biggest corporations added 39,000. This creates a split job market. Big companies are weathering the storm, while small businesses struggle. Since small businesses employ nearly half of all American workers, their decline is a major blow. The hardest hit sectors were professional and business services, manufacturing, and construction, all sensitive to rising costs and high interest rates. Even tech companies continued to cut jobs as they adjust to a new reality. The only bright spot, leisure and hospitality, added 13,000 jobs, likely due to holiday hiring. But this wasn't enough to offset the broader losses. The overall picture is fractured. Some sectors are holding on, but many, especially small businesses, are faltering. The divide between big and small is growing. If small businesses continue to struggle, the whole job market is at risk. The warning signs are clear. The foundation of the labor market is under strain. For job seekers, the shrinking pool of openings means more competition and longer searches. The days of multiple offers are fading. Employers can now be more selective. Wage growth is slowing. Year-over-year pay increases have dropped, especially for those changing jobs. Companies are no longer offering big raises to attract talent, signaling a cooling labor market. Economic uncertainty is fueling anxiety, even for those still employed. People are spending less, worried about the future, which can further slow the economy. Unemployment claims are near a 4-year high, showing it's harder to find new work after a layoff. The November report isn't just a headline, it's a sign of growing pressure on workers' job prospects and financial security. The cycle of anxiety and caution is feeding back into the economy, making recovery harder. The job loss report puts new pressure on the Federal Reserve. The Fed's job is to balance inflation and employment, and for years it's focused on fighting inflation by raising interest rates. But now, with job losses mounting, the risk of slowing the economy too much is real. The November data strengthens the case for a rate cut at the Fed's next meeting. Many expect a 0.25% cut, signaling a shift from fighting inflation to supporting jobs. Lower rates would make borrowing cheaper for businesses and consumers, aiming to jumpstart hiring and spending. Not everyone agrees. Some worry about inflation returning if rates drop too soon. But the weak labor market is a powerful argument for action. Political pressure is mounting too, as the administration pushes for relief. All eyes are now on the Fed to see if it will act to prevent a deeper slowdown. Beyond the numbers, Americans are feeling anxious about the job market. Surveys show nearly 70% expect unemployment to rise in the coming year. Personal stories, friends laid off, struggling small businesses, fuel this pessimism. Fear of job loss leads people to spend less, which can worsen the downturn. This collective anxiety can become a self-fulfilling prophecy, as reduced spending leads to more job cuts. The gap between official optimism and lived experience is growing. Even strong messaging from leaders can't erase the unease. The November job loss has confirmed many people's fears, deepening national anxiety. Right now, uncertainty is shaping both behavior and the economic outlook. November's job report was a setback, but it's not the whole story. The economy is resilient, and one bad month doesn't define the future. The report has already prompted action. Rate cuts could soon provide relief for businesses and consumers. Larger companies are still hiring, and some sectors, like hospitality, are showing life. Slower wage growth may help ease inflation, giving the Fed more room to act. The situation is complex, not catastrophic. Policymakers now have a clearer view of the challenges and tools to respond. The American workforce and business innovation remain strong engines of growth. By facing these problems head-on, we can stabilize the job market and build a stronger foundation. The sun will rise again on the American economy,